Hi guys, I'm Nicola McKenzie, founder and mortgage advisor and insurance specialist at DM Mortgages. And in today's video, I want to talk to you about level and decreasing insurance policies and which option might be best for you. Now, before we get into the detail of today's video, guys, here at Dunham McCarthy, we specialise in arranging life and critical illness insurance, as well as lots of other types of personal insurance. And best of all, we provide that advice completely free of charge. So if you are thinking of setting up an insurance policy, or you already have one and you want to review it to make sure that you've got the best possible policy in place, then make sure that you head over to our website and book in for a free of charge appointment today. Any insurance policy that we arrange for our clients, we also provide a free will writing service via mylastwill.co.uk. But for today, let's get into the detail of the video. Now, usually a level or a decreasing insurance policy would be taken out for life insurance and or critical illness cover. So a brief explanation: life insurance will pay out a lump sum if you die. Critical illness cover will pay out a lump sum if you suffer a critical illness. Now, every insurer is going to vary in terms of what they consider a critical illness. In the main, you're talking cancer, stroke and heart attack. But again, there's going to be variations in terms of quality. But fundamentally, you can take out your policy for life insurance, critical illness, or both combined. Now, whether level or decreasing is the best option for you will depend on your intended usage for the policy. There isn't really a the short answer to that is that it isn't a better or a worse scenario. It depends on your intended usage for the policy and what you're trying to get out of the cover as to which option is better suited for your circumstances. So that's the short answer. And like I said, get in touch if you want to weigh up the options to see what's best suited for your needs. But first of all, I'm going to explain what decreasing is and how it works. Then I'm going to go on and explain what level is, how it works. And then we'll look towards the end of the video about the pros and cons of each. So first of all, let's look at what decreasing insurance policies and how they work, what it is. A decreasing insurance policy is a type of insurance that's designed to help to protect a repayment mortgage. So it could pay out, like I said in the intro, a lump sum if you die or suffer a critical illness, or both of those eventualities. But ultimately, for the length of the policy, it's designed to repay your repayment mortgage. Now, with this type of policy, the amount of cover reduces in line with the way that a repayment mortgage decreases over time. And like I said, it would usually repay your outstanding mortgage balance at the time of a claim. Now, that is assuming that your mortgage, you don't make any changes to it, i.e. borrow extra, or the interest rate doesn't significantly increase. You should look at reviewing a decreasing policy every 4 or 5 years just to make sure that you haven't made any alterations to your mortgage that might affect how much that decreasing policy pays out and if it's sufficient to cover your mortgage. But the fundamentals of it, the cover amount reduces usually in line with a repayment mortgage. Now, it's worth me pointing out that the cover amount reduces, yes, but the premiums do not reduce. And the reasons the premiums do not reduce, I will come back to that point a bit later on. But decreasing policies generally are cheaper than level policies because of the fact that the amount of cover is reducing. So if you like, the discount's already been worked out up front, okay? But I'll explain more about that, as I said, later. Usually you would arrange a decreasing policy for the amount of your mortgage to match the mortgage term. Now, let's imagine a scenario where you paid off your mortgage throughout the term of the policy. It doesn't mean that the decreasing policy is void or invalid. If you still claimed during that time period, so you passed away and or suffered a critical illness, if your policy includes both, then the decreasing policy would still pay out what it would have had you have kept your mortgage in place. So even though it's designed to track a repayment mortgage, it's not directly linked to the mortgage lender. So now let's look at what a level term policy is. So level means that the amount of money that you're insured for, so let's assume it's a policy for £200,000 and you take that policy out over, let's say, a 25-year term. A level policy means that the amount of cover stays fixed throughout the term of the policy. So in other words, if you were to pass away a year into that policy, it would pay out £200,000. If you paid out, or if you passed away, in year 24 of the policy, it would still pay out £200,000 because the amount of cover stays fixed. Now, level policies are usually designed for those that have interest-only mortgages. The reason for that is because an interest-only mortgage, the outstanding balance will stay exactly the same throughout the term of the mortgage unless you make overpayments. Therefore, a level policy where the amount of cover stays fixed would usually be more appropriate for that type of mortgage. Now, that's not to say that you can't take out a level policy for a repayment mortgage, because you can. How that would work in practice is, let's say that you have a mortgage of £200,000 and you insure yourself for £200,000. Your mortgage is repayment, but you opt for a level policy. So your repayment mortgage is going to reduce over time. A level insurance policy is going to stay fixed. So what happens in that scenario? Let's say that you make a claim when the mortgage is reduced to £100,000. There's an extra surplus of £100,000 that would pay out. That payout, that extra money, would pay out to you or your family. So even though it's designed for an interest-only mortgage, it can also be used for a repayment mortgage if having surplus funds at the point of claim is something that's important to you. Now, a level policy can also be designed for those that are looking at taking out a lump sum of money to perhaps provide for their family. So it doesn't have to necessarily be linked to a mortgage. It can be that in the event of your death, you want to, give your family money for lifestyle. It might be for university costs, for a house deposit for them in the future. There's lots of reasons why those with financial dependence might want to leave extra money to their family. And in that scenario, usually people would consider a level policy. Now, the term of a level policy would usually again be linked to, if it's an interest-only mortgage that it's designed to cover, then it would be linked again usually to the amount of the mortgage for the term of the mortgage. But again, if that policy is being taken out to provide financial support for, say, dependents, then usually it might be linked to the age that those dependents might be financially independent, or it might be linked to your retirement age, or there are lots of other options as well. And again, these all depend on your individual circumstances and the intention of why you're taking that policy out. So now let's look at some of the pros and cons. Now, after that explanation, you might be thinking that level is surely better. But again, there are pros and cons to both. It's not a better or a worse scenario. So let's look at decreasing to start with. Some of the pros, some of the cons. One of the obvious pros is that a decreasing policy will usually always work out cheaper than the level equivalent option, okay? So you're usually going to save money by opting for a decreasing policy. Now, one of the cons is that typically it's only designed, like I said, to cover a repayment mortgage. And the con of that is that it's only going to pay out what's outstanding on that mortgage. So, if you have dependents that have got other expenses that they might need to cover in addition to the mortgage, then a decreasing policy may not always be enough to cover your shortfall in the event of you suffering from a critical illness or passing away. Now, some of the pros and cons to a level option is that a level term policy is going to potentially pay out more than that of a decreasing policy would have. The reason for that, going back to the earlier explanations, is that a level policy, the amount of cover will stay fixed. So people with dependents or those with an interest-only mortgage would usually benefit from a level option. One of the cons is that, like I said, comparatively speaking, a level policy is going to cost more. So if you compared the cost of £200,000 on a level basis versus £200,000 cover on a decreasing basis, and they were both for the same term, then you would find that a level policy is going to cost more than its decreasing equivalent. So there are pros and cons to both, and like I said, it's about weighing up your circumstances, why you're taking the policy out, what you're looking to get out of the policy, and only then can you work out what's best for you. If you need a hand working out what's best for you, then like I said, make sure that you get in touch, because rather than you trying to sift through the options alone without expert advice, use our knowledge and expertise to help you find the best option for your circumstances. That is what we're here for. And best of all, as I said at the beginning, we don't charge any fees to help you to advise or arrange on the best insurance for your needs. So get in touch, head over to our website and book in for a free of charge appointment today. And I hope that video has been useful. If it has, make sure that you subscribe and check out my playlist that's got lots of other videos related to life and critical illness insurance. And I'll look forward to catching you in the next video.